Hello everyone, welcome to Best of Us Investors. We as a tribe are gathering in the Discord server, where we share Carrie's portfolio, Carrie's buy and sells in real time, and we have live discussions every Mondays before the market opens and right after the market closes on Fridays in our voice channels in the Discord server. And of course, we share insights on stocks before the videos are released. The stock analysis team also analyzes stocks based on the votes from the tribe members. So hope to see you all in the Discord, where the link is listed in the description to join. We would also appreciate if you can subscribe and hit the like button, which will help our stock analysis videos. Now let's get started with our stock for this week. Today we'll be talking about Amazon. The ticker symbol is AMZN. I assume that everyone knows Amazon unless you have been living under a rock. Amazon is a $1.7 trillion tech giant that dominates and actually revolutionized the e-commerce sector, where based on the analysis released on February 2021, you can see that Amazon is of course on the top regarding retail e-commerce sales, and is almost 6 times more than Walmart, which is in second place. Now, Amazon has also built the Amazon Web Service, AWS, the world's largest cloud computing platform. They have Prime Video and the music streaming services. They got into the esports business by acquiring Twitch in August 2014, and have also got into the organic food grocery business by acquiring Whole Foods in August 2017. Here, you can get a better look at how big Amazon is and how diverse their business model is, being involved in so many sectors additional to online sales. So this image is based on the data from 2020 October, but wanted to use it since it was a well visualized image. Now, based on the net sales on June 30th, 2021, approximately 50% was from online stores where they compete with companies like JD.com and Walmart. 13% from Amazon Web Services, AWS, where their competitors are, of course, Google Cloud and Microsoft Azure. 22% from third-party selling services, whereas again, they compete with services like eBay and Etsy. We have 7% from subscription services, competing with Netflix, Disney, and iTunes. 4% from physical stores, competing with retail stores like Walmart and Costco. And 7% from the other category, which includes advertisement revenue and co-branded cards. Now, I think that as long as the digitalization revolution is here to stay, Amazon will keep growing and growing. So as the world is becoming more digitalized and convenient, the e-commerce trend is here to stay and has actually been increasing even before the pandemic. However, after the COVID crisis and the pandemic, the e-commerce trend has actually accelerated the percentage of customers shopping online, as you can see on this graph, with a peak at 2020. I personally think that this trend will not go away even after the COVID situation clears out. So I think there will be so much more growth ahead for Amazon in the upcoming future, especially if we go through another lockdown due to the Delta variant, which I hope does not happen. Now, even if we go totally back to normal and start shopping on physical retail stores as we did pre-COVID, Amazon has the Amazon Go stores where they combine artificial intelligence and is a true grab and go store and is expanding. So I personally think this AI combined grab and go model will be the future of retail stores, not only for Amazon, but in general. And Amazon is definitely on the forefront in this space. So Amazon also has an amazing moat where Warren Buffett has always suggested that you should invest in companies that have strong moats around their business. When Warren invested in Coca-Cola in 1980s, he first thought of what it would cost to rebuild what Coca-Cola business has built at that point. And Warren's evaluation was much higher than what the valuation was at that period regarding the stock prices. So he decided to purchase tons of shares of Coca-Cola. So now if you think about Amazon, what would it cost to build what Amazon has built today? So you have the e-commerce business, esports, organic grocery business, entertainment such as movies and music, and more. And of course, there are several competitors in each sectors, but to compete or build what Amazon currently has, it will be very, very hard. So I think Amazon has an amazingly strong moat around their business. There's also rumor or expectation that there can be a stock split. That would also be a very attractive factor to own Amazon shares as well. Now, some sectors that I personally think Amazon is missing are the brick and mortar stores and a social platform to increase their exposure in sales, such as where Facebook has Instagram. So I personally don't think they will build their own stores or a social platform, but might be looking for acquisitions to expand their business in these sectors. So all in all, as most would agree, Amazon is an amazing company, but unfortunately, I do not own any stocks or shares since the price has gone up so much. But would definitely want to own some shares as there are any dips or crashes that happen in the future.
So what's important to note about Amazon is that in contrast to the large quantity of retail and e-commerce stores, Amazon has no real competitors. In an industry such as that of retail, the average profit margin is tiny. The smallest change in efficiency can mean the difference between failing and staying in business. This is why retail companies won't stop shoving their rewards program in your face. Because of the fact that individual receipts are next to worthless, retail stores try their hardest to get you to sign up to their rewards program so that they can start to link your purchases together and build a profile. In this industry of retail, this is hugely important because these companies need to know what customers are buying, how much they are willing to spend, and when they'll be most vulnerable or most susceptible to advertisement. With personal data being collected from these programs, companies will be able to run their business more efficiently as they'll be able to spot trends and even make predictions. The advantage of having an online store like Amazon is that you won't need to get your customers to agree to partake in some dumb rewards program because most of the time customers will need to set up their own account on the site to purchase something. Amazon, as the biggest online retailer, essentially has a monopoly on this data and uses it to increase sales, especially of their own products and from subsidiaries. More sales lead to an upscale production, which results in cheaper manufacturing, and that leads to lower prices for the consumers, which then leads to more sales, then more and cheaper manufacturing, cheaper prices, which lead to more sales, etc. You get the idea. Amazon is a one-of-a-kind company with their fingers in every pie or industry. As they grow, they'll increase their warehouse amount. That, combined with their predictive stocking, led by their huge collection of data, will lead to unparalleled shipping times. Then that combined with them probably starting something like their own transportation service in the future will lead to cheaper shipping costs for Amazon as they won't have to pay themselves an extra fee to make profit. And that in turn will result in cheaper shipping costs for the consumer. And as Amazon grows and starts enabling these unparalleled services, everybody will start to recognize them as the best alternative to whatever they were doing, be it music, audiobooks, organic foods, or just regular retail. And Amazon will have won the game. This is what you were talking about, Drew. To get to this point, other companies will need to do so much to get to where Amazon is now. And so what costs to rebuild what Amazon currently has? There's no real company in existence now which has the resources to. And in the future, there may be, but in the future, Amazon will already be developed from beyond this point in time. So truly, it's going to be extremely difficult just to get to Amazon's level now or in the future. So I don't really see like Amazon stepping down for some better company. Amazon had about $500 billion in revenue in the last 12 months, giving them a PS ratio of about 4, similar to that of Alibaba and eBay. Their revenue, though, was much lower at 119 billion and 11.5 billion, respectively. Walmart and Target both have PS ratios of around 1. When it comes to price to earnings, almost every competitor is located around 20, except for Walmart. They are at around 40. Amazon, being the steepest of them all, is around 60. This can be explained, though, as Amazon's investors, along with the company itself, and Jeff Bezos and the current CEO, aren't concerned with how the company is doing in the present, but are looking at the future and how they'll be doing then in maybe around 10 years. Amazon's price to book ratio is pretty high. around 20. Alibaba and Walmart are the lowest at around 3 and 4. The rest is at around 10. Regarding research and development costs, I wasn't able to find Amazon's most recent expenditure, so I looked at R&D expenditure from last year's fourth quarter. Still a pretty huge amount of around 40 billion. Secondly, you have Alibaba with around 10 billion in R&D costs, and thirdly, eBay with around 1 billion. They all have a price research ratio of around 40. Amazon is just a huge company. And Walmart and Target are excluded in this sector because they don't spend money on research and development. They are a more established brand and aren't really working on anything new. Lastly, we're going to take a look at the company's operating ratios. They are all at around 0.9, except for eBay, they're at around 0.7. Also, it's important to recognize that R&D costs are part of the operating cost, and thus that higher R&D costs mean a more inflated operating ratio. So, as I said, I don't really see another competitor rising because, first off, if there were to be a competitor who would want to do the same thing, they would need to dedicate like 10 years or something, or 20, like Amazon did, of no profits, just spend everything on growth. But if they'd be doing that, Amazon would spot them doing that. Only logical that Amazon would do the same thing as they did with every other company and just buy them, you know? It's like David and Goliath, but without David.
With the cons that I see on Amazon, the first thing that just jumps out to me is their competition. They face like intense competition on almost every service that they have. They have a good range of competition in their initial e-commerce business as well. They face Alibaba and other top e-commerce websites on their online auction business. They do face competition with eBay on that. And other services that they have, for example, like the Amazon Prime Video, their biggest competition there would be Netflix, of course, Amazon Echo that has competition with Google Home, AWS has competition with Microsoft Azure and Google Cloud. They also own Whole Foods, and that also has loads of competition along with like many other grocery stores out there. They also own Twitch, which also has tons of competition, such as YouTube streaming or Mixer or something like that. Competition is generally a thing that a business would want to avoid, and Amazon has competition in almost every business that they're in. Amazon also operates internationally. That poses some risks, as some other companies that they operate in could have different local economic and political conditions, which could be often in the negative side. And so like different government regulations or restrictions on sales for certain products or things like that, that could directly impact Amazon. In China, Amazon is not like the monopoly for e-commerce there. That would be like Alibaba mostly. So it is a thing to consider in like their outside countries that they operate in. Like if they have political instability or random changes to regulations, things like that could directly impact Amazon. And the ability for profitable returns from Amazon is probably limited because Amazon is a huge company, more than $1 trillion market cap, and investing in Amazon might not provide the profitable great returns of huge growth that some other exponentially growing companies would provide. Of course, it is a great business and it is a great long-term hold, but if you are looking for some fast-growing exponential growth stocks, is probably not it, because it does have limited growth from here on, probably because it's already $1 trillion market cap. And in the future, of course, you don't know what they could be doing, and they could be into lots of different businesses. So that could provide some great growth, but like within the next 10 years or something like that, it's probably not going to provide the exponential growth that some other stocks could provide. But obviously, it's a huge and a great business, and it will still provide you great returns in the long term. With the partnerships that Amazon has, Amazon partnered with 3 companies, one of them being Global Optimism, The Nature Conservancy, and We Mean Business. These 3 organizations, and they're working with Amazon to help them get to net zero carbon. Amazon with them researches, designs new programs, and implements like strategies to get them to net zero emissions. So obviously there's just a ton of partnerships going around. Of course, they partnered with like FedEx, USPS, and UPS to deliver their packages. And Amazon also partnered with Kohl's. So if you've recently been in any like Kohl's stores, you'll see that they have Amazon return area. Like they can return whatever they bought from Amazon if they do want to return it free of charge in the partnership. Another one that they have is with the Advanced Energy Economy. This is to promote education for clean energy. And with Amazon's partnerships with them, they'll be promoting the awareness of clean energy and electric vehicles, renewable energy, and the smart grid and things like that. They also partnered with Better Cotton Initiative. That's going to support the transition of sourcing more sustainable cotton for Amazon-owned private brand apparel products. So Amazon joined the Better Cotton Initiative in 2019, which is a global organization and the largest cotton sustainability program in the world. They're trying to make global cotton production better for people who produce it and better for the environment it grows in and better for the future sector. Amazon has partnered with them to support what they're doing. So those are some of the main partnerships I see going around with them right now. Obviously, they have like loads more, but that's some of the main that I see.
Today, we're going to look under the hood at Amazon and their financials. Amazon is a behemoth, as you all know. So a lot of people own Amazon. Amazon's into a lot of different products, as you've just heard, and services. So obviously the numbers are big and huge. So let's go and take a look at the statement of operations. Okay, so what we can see is total net sales. And this is, we're going to look at from 2018 to 20. I always like to see the revenues of the sales increasing. And as you can see, from 2018 to 2020, we have increasing revenues, 232 to 386. Then you go down to total operating expense. You can see the operating expenses increasing also. But going to net income, you can see that total sales exceeds operating expense, which gives you a net income ever increasing also. So those are three things I really like to see going back. Especially for a company as large as Amazon. So if we go down and we look at the quarter to quarter, 3 months ending June 30th and 6 months ending June 30th, they just had basically their second quarter results. Operating cash flow, it all looked really well. Operating cash flow increased 16% to 59.3 billion for the trailing 12 months compared to 51.2 billion for the trailing 12 months ending June 30th in 2020. Free cash flow did decrease to 12.1 billion for the trailing 12 months compared to 31.9 billion for the trailing 12 months in 2020. This was reduced because they purchased property and equipment, so they're putting money back into the company. Free cash flow less principal repayments of finance and leases and financial obligations decreased to 0.6 billion for the trailing 12 months compared to 21.3 billion for the trailing 12 months. And free cash flow less equipment, finance, leases, and principal repayments of all other finance leases and finance obligations decreased to 4.2 billion compared to 19.4 billion for the same time period in 2020. This was reduced by equipment acquired under financial leases, so the leases must have went off when they acquired the equipment. When you look at common shares outstanding, underlying with the stock-based awards, totaled 522 million, and that compares to 517 million a year ago. So that's a very low dilution for shareholders, and they're not using it to finance the company because they have enough money to operate the company without that. So that doesn't bother me too much. Net sales increased 27% to 113.1 billion in the second quarter compared to 88.9 billion for the second quarter in 2020. Operating income increased 7.7 billion in the second quarter compared to 5.8 billion, and net income increased to 7.8 billion in the second quarter for $15.12 per diluted share compared to 5.2 billion for $10.30 per diluted share in the second quarter. So as you can see, they continue on quarter to quarter, growing revenues, growing the net income, and growing earnings per share. So let's go on to the balance. The balance sheet, as you can imagine, pretty large, and I always go to total current assets, and I look at see that total current assets exceed total current liabilities. So of course they can pay their short-term debts. Go down to stockholder equity, and you can see the stockholder equity is also increasing. It's a very solid balance sheet. Moving on to consolidation statements of cash flow. Amazon's principal sources of liquidity or cash flows generated from operations, and their cash equivalents, and marketable security balances, at which at fair value were 84.4 billion, 89.9 billion as of December 31st, 2020 and June 30th, 2021. So when you look at cash provided by operating activities, that was 20.6 billion and 12.7 billion for Q2 2020 and Q2 2021, and 23.7 billion and 16.9 billion for the 6 months ending June 30th, 2020 and 2021. Their operating cash flow results primarily from cash received from their customers, developers, enterprise, content creators, advertisers, offset with cash payments they make for the products and services, employee conversations, and on and on. So as you can see, cash from operating activities is increasing, and that's where you generate the money to run your operations. We'll look down at cash provided by and used in investing activities, and that corresponds with cash, capital expenditures, including leasehold improvements, incentives received from property and equipment vendors, proceeds from asset sales, cash outlays for acquisitions, investments in other companies' intellectual property rights, purchases, sales, and maturities of marketable securities. Cash provided by or used in investing activities was negative 17.8 billion and negative 22.1 billion for Q2 2020 and Q2 2021, and negative 26.7 billion and negative 30.7 billion the 6 months ended June 30th, 2020 and 2021. The variability is caused primarily by their decision to purchase or lease property and equipment and purchase of sales and maturities of marketable securities. So they use that money and invest it into basically equipment. So cash provided by financing activities was 7.4 billion and 15.6 billion for Q2 2020, Q2 2021, and 4.8 billion and 12.2 billion for the 6 months ended June 30th, 2020 and 2021. Cash inflows from financing activities resulted from proceeds from short-term debt and other long-term debt of 12.4 billion and 19.7 billion for Q2 20, Q2 2021. So if you look at their cash flow, when we get down to the cash and cash flow prints for the end of the period, you can see that the cash flow and cash equivalents is also growing. When you look at the financial summary, and this is just based on what I look, these are the 8 basic things I look at, and then I look at other things. But for me, revenue is constantly increasing, so that's a plus. Operating income is constantly increasing, that's a plus. Net income is increasing, that's a plus. Per share earnings is increasing, that's a plus for me. Number of shares is slightly increasing year over year. I put it as a negative, but it's not really a negative because they're not really diluting your shares. Not like a growth company that uses shares to go and finance their operations. They're just using it basically for rewards to employees. So I'm not so worried about it, but I gave it a negative just so it had one. Balance sheet, current assets are greater than current liabilities. That's a plus. Stock-based compensation, again, shareholders are being rewarded at the same time or before the executives and employees. So I like that sharing of the wealth. Liquidity and capital resources, most cash is provided by operations, not by investing activities or by offerings or notes. So when it comes to Amazon, it's a company I really like, a company that is my largest single company that I own shares in by far. And I've been in it a long time, and I think it's going to continue to grow. For me, Amazon is comparable to Berkshire Hathaway, and I think you're going to see the same kind of growth, if not even more, out of Amazon in the future. If you're going to get into Amazon, it's very expensive now. I mean, it's at its all-time high or getting to that point. Make sure you look in, get a good entry point dollar cost average in. If you can buy fractional shares on some brokerage platforms. You can also get it through some ETFs that are highly invested in Amazon. But again, everyone should have a little Amazon, in my opinion, but do your own due diligence.